Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Symbotic.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. If there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. Symbotic is one of the most exciting growth stories in logistics right now.
And maybe one of the most misunderstood, too.
I think so. At its core, this company is a dominant innovator in AI-powered warehouse automation. The real story here is about high growth that is now, finally, shifting toward profitability.
They're not just selling robots, right? They're redesigning the whole system.
Exactly. And that high-level pitch, it's really backed up by the financial data. That's where the conviction comes from.
Let's talk about those numbers. The revenue growth they just reported for fiscal year 2025 was exceptional.
It was. The company reported revenue hitting $2.25 billion.
That's the headline number. But the year-over-year comparison is where it gets really impressive.
It is. That's a 25.65% increase from the $1.79 billion they did in FY 2024.
And in this space, in AI logistics, keeping up a growth rate over 25% is, well, it shows they're just gobbling up market share.
They are. They're outpacing competitors who are, struggling with the execution. And analysts don't think this is a flash in the pan.
No. The forecasts project annual revenue growth staying really strong, somewhere between 20 and 35%, at least through 2027.
But here's the pivot. This is where the story shifts from just being about growth to being about a de-risked business model. We've had a huge inflection point.
The cash flow story.
The cash flow story. Now, we should be clear. For the full year, they did report a net loss. It was around $16.94 million.
Right. And EPS was negative 16 cents. So for some investors, seeing that full-year loss might be a red flag.
It might. But for a company like this, one that invests so heavily in R&D and massive physical deployments, free cash flow, or FCF, is the metric that matters.
It's the true indicator of operating health.
It is. It's the cash you generate after paying for everything. And the big news is that Symbotic just achieved its first quarter of positive FCF.
So they've finally hit escape velocity.
That's the perfect way to put it. It means their investments are now generating enough cash internally to fund their own operations and growth. The operating leverage is kicking in.
So sustained profitability isn't just a hope anymore. It's becoming an imminent expectation.
Exactly. The core engine is now self-sustaining, and they have the capital to back it up.
Yeah, looking at the balance sheet, they ended the year with, over $500 million in cash and equivalents?
Over $500 million. And get this, their net debt position is negative.
Meaning more cash than debt.
In plain English, yes. They have incredible financial flexibility. They can fund innovation, they can be aggressive, and they don't have to run to the markets for capital. That's a huge advantage.
And that financial strength is what lets them protect their competitive advantage, their moat.
Absolutely. And let's talk about that moat. First, just look at their customer base. We're talking Walmart, Target. These are the titans of logistics.
Having them as clients is the ultimate validation. It proves the system works at an unbelievable scale.
But why can't a competitor just come in with a cheaper robot and steal those customers?
The switching costs.
The switching costs are astronomical. Symbotic has a proprietary modular robotics platform. It's a complete system architecture. Once a company like Walmart integrates this, ripping it out is just not a viable option. It creates incredible client stickiness.
And that brings us to their newest innovation, the new storage platform they launched in late 2025. This sounds like a major growth catalyst.
Oh, it's a game changer. It hits the two biggest pain points for every retailer, space and speed.
So it shrinks the warehouse footprint.
It slashes it, and it speeds up how fast they can deploy the system for a customer. So the ROI for that customer gets exponentially better. It makes their solution even more compelling.
So you've got the tech, the A-list customers, and now the cash flow. It's clear why the market is so bullish.
It is. So let's pivot. How has the market reacted? What are the charts telling us about investor sentiment?
Well, shifting to the technicals, the picture is extremely bullish. We've seen a phenomenal rally this year.
It's been a monster run.
The stock went from around $16 early in 2025 all the way to a high of 84. And right now, it's consolidating.
Which is healthy. It's digesting the good news from the earnings report. So where's it sitting now?
Around the $70 to $75 range. And that consolidation is build a nice base.
Okay, so what are the key levels investors should be watching? Where's the floor?
There's strong support forming in that $55 to $60 range. The stock has been making higher lows this whole time, which is what you want to see.
And on the upside, the breakout point.
That would be the recent high, the $80 to $84 level. A solid break above that would signal the next leg up is starting.
What about momentum indicators? Is there a risk that this thing is just overheated?
Not right now, no. The price is staying comfortably above both the 50-day and 200-day moving averages, and they're both trending up. That's a classic sign of strength.
And RSI and CD.
Neither are signaling overbought conditions. It looks more like healthy, controlled accumulation, not a speculative bubble.
Okay, that's reassuring, but we have to talk about the elephant in the room with this stock, the volatility.
Your beta, yes.
That's 2.11. For anyone listening, let's just be very clear what that number means.
It's a crucial point. It really defines the risk profile here. Beta measures how sensitive a stock is to the market. The S&P 500 has a beta of 1.
The baseline.
Right. So a stock with a beta of 2.11 will on average move 2.11% for every 1% move in the S&P 500.
So when the market is going up like it has been, that's fantastic. It amplifies your gains.
But you have to understand, it works both ways. If the market hits a rough patch, a risk-off environment, this stock is likely to fall much harder and faster than the average. It is not for the faint of heart.
Makes sense. All right, so speaking of risk, let's talk about what the company's been doing on the governance side. They've actually de-risked quite a bit recently.
They have. There were two really big events.
The first was about the board, right?
Yeah, back in August 2025, they expanded the board of directors, adding a 9th member, Andrew Ross. It's a sign of maturity, beefing up strategic oversight as they scale.
And the second point was even bigger, I think. It cleared up some noise that had been hanging over the stock.
A huge relief for institutions, for sure.
There was that previously disclosed SEC investigation. It was related to some alleged rule violations and a revenue restatement back in 2024.
And the SEC concluded it.
Concluded it with no recommendation for any enforcement action. That's a huge cloud lifted. It removes a major overhang on the share price.
We also saw a good sign from inside the company, right? The CTO.
Exactly. The chief technology officer converted a block of RSU's restricted stock units into common stock in November. It shows executive confidence. They believe in the long-term story.
Okay, so the governance risks seem to be fading. What about the core business risks? The execution side?
There are two main things to watch. First is just the sheer difficulty of scaling these massive, complex deployments. Any delays or glitches can hit the bottom line hard.
And the second risk is actually tied to their strength, that amazing customer list.
Yes, customer concentration. Having Walmart and Target is fantastic validation. But it also means a huge portion of your revenue is tied to just a couple of clients.
So if one of them were to pause spending, it would have an outsized impact.
It would. And that high beta we talked about just amplifies both of those risks.
Right, so vigilance is key. Okay, let's look ahead. The catalyst calendar is packed for the next few months.
It really is. This is where things could get very active.
So what's first up? We have December 20th, 2025.
That's a key ETF rebalancing event. As Symbotic has gotten bigger, its weighting in different indexes has gone up. The rebalancing could force big passive funds to buy or sell, which can definitely move the stock.
Then, right after the new year, January 6th, a big sector check-in.
That's the Holiday Automation Volume Report. It's sector-wide data on how well warehouse robotics performed during the peak shopping season.
So if the report is strong, it's a good sign for Symbotic's forward bookings.
Exactly. The market sees them as a bellwether. Then later that month, January 30th, we get to see who's been buying.
The 13F filings deadline.
Right. All the big money managers have to disclose their holdings. If we see that some major funds have been building a big position, that news alone can act as a catalyst.
But the date everyone is probably circling on their calendar is February 19th, 2026.
Without a doubt, that's the Q1 earnings release for fiscal year 26.
And this is the one that should confirm the big story.
It is. This is where we expect to see the first full quarter of positive free cash flow. It'll also give us the first real data on how quickly customers are adopting that new storage platform.
A beat on both of those metrics could be explosive.
It's a recipe for serious upside. And beyond those hard dates, you've always got the rumor mill.
Of course. What's the chatter?
It's all about diversification. Chatter about new Fortune 100 customer wins, which would help with that concentration risk. There's also talk about international expansion, maybe into the APAC region.
And when you zoom out from all that, the long-term story is still the main draw.
It really is. The structural tailwinds are just so powerful. Warehouse digitalization, rising labor costs, the complexity of modern retail. Symbotic's technology is a direct solution to all of it.
So let's bring it all together. What does this mean for you, the person listening, when you put the fundamentals and the technicals together?
Well, the core thesis is very strong. You have a leader in a growing field with outstanding revenue growth that has just crossed that crucial hurdle into generating its own cash.
And the technical picture is bullish, with a packed calendar of potential catalysts dead ahead.
Exactly. So the decision for you is really about your timeline. Do you see this as a shorter-term trade playing the catalysts into Q1 earnings?
Or is this a core long-term holding? Something you buy based on those structural tailwinds that could drive performance for the next decade. Based on their execution so far, the risk-reward looks pretty attractive, as long as you can handle that volatility.
If you want more cutting-edge analysis like this, make sure you hit that subscribe button to catch our next Stock Talk.